Today we're going to take a couple minutes and talk about estate planning for the family cottage. An oceanfront piece of property was purchased 5 years ago for $38,000 by Mr. and Mrs. Smith. They spent another $40,000 for material and built the cabin themselves. Today that piece of property and cabin is worth about $300,000. Mr. Smith is 57 and Mrs. Smith is 52. They want to leave the cabin to their 3 adult children, and the question becomes, how much tax would be payable? Family cottages are generally not exempt from tax like a principal residence. When you pass away, everything you own is deemed to be sold at fair market value, which includes your cabin. Most family-owned cabins were purchased years ago for a fraction of what they're worth today, and the difference in the purchase price and the selling price is called a capital gain. Your estate has to pay tax on that gain. So if we look at the Smiths as an example, the cabin has an ACB of about $78,000. ACB stands for Adjusted Cost Base. Basically, it's accountant's speak for what you paid for it. The Smiths paid $38,000 for the lot, plus $40,000 in material, so their ACB, or purchase price, is $78,000. The cabin also has a fair market value of $300,000. So today, there's a capital gain of about $222,000. $300,000 fair market value minus the $78,000 of ACB. Half of that gain is taxable, and the Smiths would have to pay a tax bill of approximately $50,000 if they were to both pass away today. But the Smiths are still pretty young and healthy. Mr. Smith and Mrs. Smith enjoy years of fishing, boating, and relaxing at the cabin. Over the years, the area becomes more popular as a tourist destination, and obviously the value of the cottage and the land is going to increase. At age 83, Mr. Smith passes away. The cottage passes to Mrs. Smith tax-free as a spousal rollover, and she lives to age 85. How much tax would be payable when Mrs. Smith dies at age 85? If we assume a 4% annual appreciation on the property, the $300,000 fair market value today would grow to over $1 million at her age 85. And if they haven't done any significant improvements to the cabin, or have the receipts to prove it, they're going to have a capital gain of about $1 million. Half of that is taxable, and the estate is facing a tax bill of over $200,000. Most people aren't aware of the potential tax burdens on family cottages. Putting your kids on title doesn't necessarily get around it, putting the cabin in a trust won't get around it, and claiming it as your principal residence generally doesn't get around it either. So we need to come up with a new plan. So what can the Smiths do? They can give it to their kids today and pay the $50,000 tax bill today, and the future capital gains would become the kids' problem. They can keep it, and their estate is going to have to write a check to Canada Revenue for a little over $200,000 years from now. Or they can purchase some life insurance to fund this tax bill. What would insurance look like? In this case, we do something called a joint last to die policy, which is a horrible name for it, but because the tax bill happens at the last death, we designed the policy to pay out on the last death. A tax bill is a dollar for dollar transaction, which means if you owe $1 in tax, you have to pay $1. Insurance is not a dollar for dollar transaction. It doesn't cost you $1 in insurance premiums to get $1 out at claim time. Insurance costs pennies on the dollar. So insurance is a far more efficient way to fund a tax bill. Anybody in this situation should explore using life insurance as an alternative to having to sell off the family assets to pay for the taxes to the estate.